Hey everyone, I'm Professor Stefan, and in this video we're going to talk about current liabilities. Current liabilities. Wait a second. Current liabilities? Sorry guys. Current liabilities. There we go. Alright, let's get started. Okay, so we've seen the definition of a liability before. This is the probable future sacrifice of an asset or a resource due to a current obligation that has arisen out of past events. And so we learned back in the balance sheet video that, the firm has to currently have an obligation for a liability to exist. It has to have resulted from a past transaction, so there has to have been an exchange of goods or services or cash or something like that. The obligation has to require the outlay of some future resource, usually some form of asset or service that you're going to provide. And finally, the amount has to be quantifiable, or it has to be estimable. We have to know what the amount of the sacrifice is going to be. If we don't know the amount, we can't record a liability on our balance sheet. And so we're going to split our liabilities into two groups. We're going to have current liabilities and non-current liabilities. So current liabilities are those that we expect to pay off within one operating cycle. And for the vast majority of firms, that is going to be within 1 year. Now, there is a little bit of kind of leeway here where if a company has some debt coming due in the current year within the next 12 months, but they intend to and they have the ability to refinance, GAAP will let them continue to list that liability as non-current because it's highly likely that it's going to remain kind of a long-term debt once they refinance. Now, the second type of liability here, the second classification of our liabilities are non-current liabilities, and these don't have to be fulfilled for kind of more than one operating cycle out or more than 1 year out. Now, it's important to note that a single liability, this is usually the case for various types of long-term debt, especially long-term debt, things like mortgages, or maybe you have to make a quarterly principal payment or something like that. If you're making periodic payments on your debt, the amount of that loan that is going to be paid off in the next 12 months, that is going to be split into a current liability that we call the current portion of long-term debt, and the rest of the note or the debt you have that's going to be paid off more than 12 months out, that piece will be listed as a non-current liability. So you can have a single loan that gets split up into two lines on your balance sheet for the current portion, that which you're going to pay in the next 12 months, and the non-current portion, more than 12 months out. Now, our coverage of current liabilities is going to talk about accounts payable, sales taxes payable, gift cards, and warranties. But there are a host of other types of current liabilities. There is a very broad spectrum of liabilities, things like wages payable, salaries payable, payroll taxes, unearned revenue. We've talked about a lot kind of back in the revenue module. And so there are all sorts of other current liabilities that you're going to see, different accrued expenses. There's kind of compensated absences. So, PTO or, vacation days or sick days, that kind of stuff companies have to accrue. There are tons of different current liabilities. We can't cover them all here, but hopefully giving you the flavor of these four is going to make the other ones very easy to learn kind of when you see those in practice. So let's start with accounts payable here. So accounts payable are promises by the company to pay a supplier for goods or services. And this is usually kind of an open line of credit, relatively informal. It's just the flip side of the accounts receivable that we've seen. So it's just this kind of agreement between two companies one of them is a supplier and one of them is the customer. And they'll offer, 30 days or 60 days or 90 days to kind of pay off whatever they have ordered from the supplier. Now, also just like accounts receivable, the accounts payable side of things can deal with these payment discounts as well. We learned about the terminology, 210 net 30, where if you pay in 10 days, you get a 2% discount. Otherwise, it's due in 30 days. That same thing applies to accounts payable here. So let's take a look at this discount scenario that we saw with accounts receivable. Let's say Macattack Inc. buys $20,000 of inventory and they are offered the terms of 210 net 30. So if they pay within 10 days, they get a 2% discount. Otherwise, they owe the full amount in 30 days. And so just like accounts receivable, we are going to deal with this kind of with two accounting options. We have the gross method, where we assume we will not take the discount. And we have the net method, where we assume that we will take the discount. And so just to see kind of what the journal entries look like here and how closely it mirrors accounts receivable, let's say Macattack uses the gross method and they're going to assume that they do not take the discount. When they initially buy this inventory, they'll record the inventory at the full $20,000, again, assuming no discount, and their accounts payable liability at the full $20,000. Now, if they decide to pay early and take the discount, so they kind of change their mind in there, they're only going to pay $19,600 in cash, or kind of 98% of that purchase price. But their full liability goes away, right? The $20,000 accounts payable they originally recorded completely disappears because they have no liability remaining. But what this means is that 1, our journal entry doesn't balance, and 2, we only ended up paying $19,600 for the inventory that we bought. But up in our initial entry, we recorded the inventory at $20,000, so it's kind of overstated right now. So this $400 difference in this entry is going to reduce our inventory value down by $400 to the $19,600 that we actually paid in cash to our supplier. Now, if our assumption was correct and we do not take this discount, then we have a simple payment of cash of $20,000 and our accounts payable disappears again. Now, if we're looking at the net method, this is where we assume that we will take the discount. So we're only going to record inventory at $19,600, or that 98%, and we'll record the liability also at the $19,600. And if we pay early and take the discount like we assumed, everything is pretty normal. We pay $19,600 and the liability goes away. But if we don't take that discount, we kind of change our minds, then that means we have to pay cash of the full $20,000. Our liability goes away, our accounts payable goes away that we originally recorded of $19,600. But now again, we have a journal entry that doesn't balance. When we initially recorded our inventory value, we recorded it at $19,600, but we ended up paying a full $20,000 in cash. So we need to increase our inventory balance by $400 in order to get it up to the actual cash payment that we made for that inventory. And so you can see that this very much mirrors accounts receivable, where we're going to make an assumption about whether we take the discount or not. And if we're right, we're fine. And if we're not, then we just have to kind of true things up here with changes to the inventory value. So accounts payable is so important because it is usually one of the largest current liabilities on companies' balance sheets. So if we take a look at Amazon's operating cycle here, we can see leading into a holiday season, they know they're going to have a lot of sales, right? As people buy, gifts. And so they're going to start acquiring inventory early on to prep for this season. So they're going to buy inventory and record kind of a large accounts payable leading into the end of the year. Now, over the course of, November and December, they're going to have a whole lot of sales to customers. And so they're going to kind of get some receivables and start collecting cash from their customers. And then after the end of the year, they're going to take that cash they got from their customers and pay off their accounts payable. But with a calendar year end, you would expect, given that they're still in the process of collecting all this cash from their customers, their accounts payable balance is going to be quite large here. And so we can see accounts payable out of their liabilities and their current liabilities is definitely one of the largest ones that Amazon has on its balance sheet. So that's it on accounts payable. The other topic I want to cover in this video is sales tax payable. This is a fairly simple topic, but it is very common, right? And in your day-to-day lives, you've paid sales taxes as well. And so the way sales tax works is that, a state will say, hey, we've got a 7% sales tax, right? And instead of the state going around and collecting sales tax from every individual, they say, hey, businesses, those of you that sell to end customers, you need to collect the sales tax for us and hand it over, every month or every quarter or something like that. And so the companies are the ones that have to collect this and remit it to the state. And so a simple example here, let's say we have Parrot shoes and they sell a pair of sandals for $100 and sales tax in the state is 7%. Well, as you know, you as the customer, you're going to have to pay the full $107. You're going to pay the sales price and you're going to pay the sales tax. So Parrot shoes is going to collect $107 in cash. But the actual revenue they receive on this is only the $100 sales price for the sandal. The other $7, the extra $7 that they're going to collect is going to go straight into a sales tax payable liability. So they're saying, hey, this extra $7 we got from you, we owe this to the state. It is not revenue to us. We're just holding on to it. and we're going to record a liability immediately for that $7 that we owe to the state. And then eventually, I don't know how often it is, every week, every month, every quarter, they remit these sales taxes to the state, or they pay them to the state. And so in that case, they'll credit cash for $7. They'll write a check to, the state of Colorado, and they will debit that sales tax payable liability to get rid of that thing now that they have, paid the $7 they collected to the state. So sales tax payable, very straightforward. There aren't any kind of tricks here. It's just the company bringing in extra cash and recording the liability, and then the liability goes away when they pay it to the state. So closing thoughts here, current liabilities, these are obligations we pay within 1 year or one operating cycle. Accounts payable, this is one of our largest current liabilities in most cases, and it's this kind of informal agreement between a customer and a supplier with a due date and potentially discounted kind of payment terms in some cases. And then sales tax payables, these are just taxes that are collected by a company that they have to pay out to the state. And so when they collect those taxes from the end customer, they immediately record a liability. It does not become revenue for that company. It's just a liability saying, hey, we're going to have to pay this out in, a month or a quarter or so. So thanks for watching.